It's almost 1 p.m. in Sydney, 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks fluctuate as US futures edge higher, with traders mulling the rotation out of tech and the likelihood of Fed rate cuts. The yen in focus, with faster Tokyo inflation keeping a BOJ hike in play. Also ahead, Chinese battery maker CATL on course for a jump in second quarter profit when it reports shortly, and a fresh gauge of EV demand. And let the games begin with the Olympics opening ceremony just hours away. We report from Paris on the last-minute preparations. Right, first though, let's check in on how markets are faring around the region with Avril Hong in Singapore. Avril.
Yeah, Paul, after all that selling earlier in the week, stocks getting a bit of a breather today. A lot of it earlier in the week had to do with the rally in the yen as traders bet of that narrowing gap between the US and Japan on yields. That's what sparked this widespread liquidation across markets, traders reassessing their leverage bets. And overnight, we saw the US Treasuries as well as the Japanese yen pairing some of their gains after US GDP came in faster than expected. We also have the Nikkei a day ago entering correction. It's slightly firmer today, but the TAIEX and TSMC, as markets reopen in Taiwan, they're catching down those concerns about AI, whether it can still drive the rally in stocks. Flip the board because I wanted to highlight this chart, which will show you the correlation between the Nasdaq and the dollar yen. That relation has turned positive. We've seen this a handful of times in the past decade. That's usually meant pressure on tech stocks. And this is because the yen is seen as this cheap source of leverage, and that is what's funding the tech rally. Where the yen goes from here depends a lot on what the Fed does next week. And ahead of that, we have the likes of Bill Dudley saying that the US Central Bank has no reason to wait on cutting rates. Have a listen.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in the employment.
All right, Avril, stick around. We're going to get more on markets with our first guest, who thinks at least one Fed rate cut is a given, but his base case is for 2 reductions this year. Hamza Ayub, portfolio manager at CATL, joins us now from Singapore. And Hamza, I just want to start off right away with our question of the day today. Catalyst and attention now turning to the Fed. Do you feel like next week's Fed meeting might reverse the stock sell-off that we saw over the past couple of days?
Look, nobody has a crystal ball. I think what's more important is the numbers that we're seeing right now coming into this week. Everybody's expecting that we may see a downside risk to the PCE tomorrow, but such is the nature of this cycle that surprises are normal. And we saw the advanced GDP data and also the quarter-on-quarter PCE deflator that came in higher than expectations. So unless there were revisions backing this higher PCE deflator, we feel that tomorrow now the balance of risk to the upside. And when I say that, such has been the nature of this cycle, if you look at the Cleveland CPI nowcast, it was actually showing a month-on-month decline in PCE. So this cycle has been very, very difficult to call. As far as the Fed meeting, most probably they will keep a more of a communication approach. This is our view. We still feel that the first rate cut comes in September, which is a given. Market, by the way, is right now pricing in close to 3 rate cuts, but we feel 2 are our base case.
Hamza, I just want to pause for a moment and mention that headline viewers will be seeing across the bottom of the screen there. China's 10-year yield now falling to a fresh record low, 2.181. So measures from the PBOC to stop that yen, to stop that bond rally, not really working out. The 10-year yield now falling to a fresh record low. But let's get back to the Fed and next week's meeting. We did have that GDP read today. Really seemed to be in the sweet spot, really. And even though we had tech selling off, we saw a rally in some of these other economy-linked names and sectors like financials, industrials, energy as well. Where do you place the prospect now of a soft landing, and where are you rotating your allocation to?
Look, soft landing has been a consensus for over a year now. right? Overall, if you look at how the market was pricing in, the valuations, the risk premium, the volatility across asset classes, even on the VIX side, you look at credit side, although we have seen an inversion of the curve for the longest period of time, other corners of the market, they were just showing that soft landing is now a consensus, it's more than fully priced in. Now, as far as the numbers are concerned, as you would see that in the first quarter of 2024, there was a broadening in equity rally, and that was based on the simple fact that inflation rose for the right reason, growth was surprising to the upside, and then all of a sudden, market took a step back and started reassessing the growth prospects. This GDP number kind of puts back GDP growth on the higher end of expectation, and what we are seeing right now is our expectation is that it's good for actually non-tech stocks, and we continue to see this rotation playing out. If GDP remains okay, we will continue to see a catch-up and an improvement in market breadth.
Exactly how deep of cuts do you expect? You say the Fed will start in September, but beyond that, how deep and into next year, what kind of magnitude of cuts are you expecting?
So next year is very difficult to call, by the way. So if you look at the market expectations right now and the probability curve for next year in 2025, actually, the variance is actually as much as the mean. By this, what I mean is that there are about 4 more rate cuts priced in, but the range is actually 100 basis up and 100 basis down. So it will actually depend on the policy, number one. We have elections coming in the US. It will also depend on the fiscal side of things, how fiscal side pans out. So I think it's right now, market is pricing in around 3 to 4 rate cuts, but it's not a given. One thing we also have to be mindful of over here is that we could well see an environment where Fed cuts 2 to 3 times this year or early next year, and there's a long pause.
What's that going to mean for the yield gap between the US and Japan? Do you think it's going to come down enough to prompt a further rally in the yen?
Look, again, we were of the view that the convergence or the interest rate differentials between dollar and yen, they will continue to kind of reduce, right? And should next year, for example, 2025, for example, if we don't see rate cuts in the US and there's a long pause, then obviously we could see the trend of yen weakening continuing into 2025 also.
Hamza, we saw PPI numbers out of Japan and Tokyo CPI numbers today as well that seem to support this idea of some tightening from the BOJ next week. What are your expectations around that in terms of what we might see and the risk of the BOJ missing its chance to move?
Look, BOJ is in a bit of a quandary right now. On one hand, they're seeing inflation above target. On the other hand, it's possible that most likely they will reduce the growth target. So they are not going to do anything. This is our base case in July. Probably they'll set the stage for September rate hike. But as far as July is concerned, there is some risk. Market is worried, but we don't see that.
Do you think Japanese equities can tolerate BOJ tightening?
Look, it's as far as growth remains okay, right? Japanese equities are not only a macro play, which has been over the last 1 or 2 years or so. It's also a play where companies are finally waking up and going through their corporate governance reforms. They are doing what US firms are accustomed to do, which is pay back capital to shareholders, improve return on capitals, improve margins, and become more efficient. So even in a tightening scenario, eventually we could see some hiccups because portfolio managers like us will reassess the situations because a lot of money has been already made in Japan. But eventually it all depends what these corporates do. And it's likely that these corporates will continue to do what's in the best interest of shareholders.
Okay. Amid all this, we are seeing how the unwinding of carry on the yen has, in a way, this week at least, benefited the Chinese currency. Where do you see the PBOC treading going ahead? I mean, we're seeing how Chinese bonds have been reacting this week as well.
Look, we are not experts in China. We frame China within the context of the world, and the best way to frame China is what's happening in the US versus China. So if you look at US has one foot on the accelerator and the other foot loosely on the brakes, meaning fiscal deficit and the fiscal spending is very high. On the same time, they've been keeping rates high. What we have over here is a growth impulse. In China, it's kind of a flip side. On one hand, they have a foot which is firmly on the brakes, which is the demand side of the equation. And on the other hand, they are loosely putting their foot on the accelerator. And the PBOC cuts, which were unexpected, doesn't change things on margins because it's just another attempt to push the accelerator. May not be enough to revive animal spirits overall. What we feel in terms of China, we feel the recovery of China is similar, could be similar to what we saw in US after the global financial crisis, with a slow recovery, and one needs to be very, very patient.
What about reviving animal spirits in tech, specifically for the AI sector? Is the Fed going to do anything that would support this, or are we going to have to wait until we actually see NVIDIA, the big dog in AI, dropping its earnings for it to continue that rally?
Look, nobody has a crystal ball. We feel that the biggest risk to right now markets is actually tech, right? Because the way we see markets right now, especially US markets and global markets, by the way, is that there are two kind of sides of the market. One is the big tech natural monopolies, which are around 30 to 40% of US equities. And on the other side, they're like competitive cyclical industries. So they are actually both macros at this point in time, right? So should the earning growth expectations that are getting priced in or have been priced into tech, they come to a situation where markets start questioning that, because all this AI spend, whether it will be monetized or not, that's still a question mark, right? And that could actually be a very, very big for risk for equity markets, right? And we also have to consider the fact that these big tech companies, the reason they are monopolies is not only because they are big, but also they can actually impose certain products and services on consumers and businesses, right? And that's what markets really focusing on right now, that they will persuade consumers to use applications in AI, hence their profitability will increase. But if that's not the case, then it's a big, big risk we're seeing for markets.
Yeah, we'll have to wait and see whether those earnings actually come through the way that some investors might like with the Mag 7s as well, the rest of the reporting season. Hamza, thanks very much for weighing in. Hamza Ayub of Faro Capital. Back to you, Paul.
All right, thanks, Avril. Still to come on Bloomberg Markets Asia, our exclusive interview with the CEO of KPIT Technologies, an Indian software services provider for the auto sector. We discuss opportunities for growth as car makers turn their focus to tech enhancements. First, though, Vice President Kamala Harris says she pressed the Israeli Prime Minister for a Gaza ceasefire when she met Benjamin Netanyahu in Washington. We'll have details of that next. This is Bloomberg.
It is time for this war to end, and end in a way where Israel is secure, all the hostages are released, the suffering of Palestinians in Gaza ends, and the Palestinian people can exercise their right to freedom, dignity, and self-determination.
US Vice President Kamala Harris there, speaking after her meeting in Washington with Israeli Prime Minister Benjamin Netanyahu. And this is after President Biden's earlier meeting with Netanyahu in his first talks with a foreign leader since dropping his re-election bid. Netanyahu thanked Biden for his support and pledged to keep on working with him, despite clashing over Israel's handling of the war against Hamas. So let's get some more on this with Bloomberg's Vonnie Quinn in Washington. So, Vonnie, what are the key takeaways from Netanyahu's meetings, both with Kamala Harris and Joe Biden?
He really has to take not just a two-pronged approach, Paul, but a three-pronged approach. He visits Donald Trump in Mar-a-Lago on Friday afternoon. And obviously he had these meetings with Biden and Harris. There's no knowing who's going to be in the Oval Office in 2025 if presumably the war on Hamas continues until then. President Biden says he wants a truce. He wants a ceasefire even within the next 6 months while he's still in office. It's unclear if that will happen. Israel now, according to Reuters, are putting up more conditions on a truce that had been in the works. But Kamala Harris, for sure, is putting up a more strident tone with Benjamin Netanyahu. She spoke not just, in a statement that you just saw there, but she also addressed the protesters that have been in and around the capital all week. She said that she sees and hears the protesters, and she spoke a lot about Palestinians. And she said, what has happened in Gaza over the past 9 months is devastating. I will not be silent. That's something that you would never hear President Biden say openly and publicly in such stark rhetoric as that. So Netanyahu, having given that fiery speech to both houses of Congress, as well for his domestic audience in Israel as here, has to make sure that he keeps everybody on side right now.
So let's assume we end up with a Harris administration. What sort of national security stance could we expect?
Well, we're definitely hearing more from senior Democrats who are trying to bolster her credentials as somebody who is very versed in foreign policy and who's well able for it. We also know that as Vice President, she travelled the Indo-Pacific quite substantially. She met with leaders in South Korea, in Japan, Vietnam, the Philippines. That was one of her briefs. We've heard several times this week that in the Situation Room, she's had a cool head. She has interpreted meetings and added to them in a very substantial way. Earlier this week, we heard from Antony Blinken, the Secretary of State, and just on Thursday, Lloyd Austin, Defence Secretary, weighed in as well, saying that she had been very, very helpful in Situation Room meetings. We're also hearing from Democrat advisors that she might perhaps be a little bit for more funding for the Pentagon. This was something that we wouldn't necessarily have known before now. Hawks in Congress want more funding to go to the Pentagon. Obviously, Doves are not too worried about that particular issue. But if there were to be more funding, it would go to things like submarine building, which would help the AUKUS deal and so on. And the general impression that's trying to get out there on the part of Democrats is that this is somebody who is a serious contender. She would be open to other countries and to alliances on the political stage. She would bolster America's credentials, and particularly in the Indo-Pacific region at a time when it's perceived that China is flexing its muscle.
So, meanwhile, back on the campaign trail, we've got Donald Trump's campaign refusing to commit to a debate with Kamala Harris. What's going on there?
This was a little bit of a turnaround once again today, Paul. I mean, it's not for sure yet that it won't happen, but what we did have was a statement coming from the Trump campaign to suggest that the Democrats are in chaos and that until they have formally chosen a nominee, that there's going to be no commitment on the part of Donald Trump to any debates. Now, we know that the DNC takes place in the middle of August and the first debate wasn't scheduled until September 10th anyway. So there is plenty of time for Donald Trump to actually agree to the debates. But it wasn't until Kamala Harris spoke to reporters earlier on Thursday and said, let's go. That was literally her comment. She is ready. She wants the split screen, as she said, in front of the American electorate. It wasn't until after that you saw Donald Trump basically backpedal on remarks that he had made to reporters on Monday, in which he said that he would be happy to debate her, and not just once, but more than once.
All right, Bloomberg's Vonnie Quinn in Washington. Relations with China, also a key focus. We had a group of US executives that visit China this week to meet with senior officials, receiving conflicting signals over Beijing's openness to foreign investment. For more, Asia government and economy correspondent Rebecca Chun-Wilkins joins us now. So, mixed messages. What did these CEOs hear?
Well, it's clear they received a warm welcome from Chinese officials. They had really quite high-level access. They met with He Lifeng as well as leaders of other ministries, and they did discuss parts of the third plenum, sort of trying to understand a little bit more about what that means. But as you say, some conflicting signals. On the one hand, this very warm welcome, this suggestion that FDI, foreign direct investment, is still deeply important to China. But on the other hand, also this emphasis on self-reliance and innovation, essentially to protect China against efforts by the US and other countries to constrain its economic and technological rise. And so, you know, executives from companies like Apple, Micron, Goldman Sachs that were all there are having to contend with these two objectives that seem somewhat contradictory.
To what degree is the election in the US casting a shadow over this? Could we expect perhaps some more clarity from Beijing over foreign investment in 2025?
So, interestingly, the US election didn't actually come up at all in discussions between US executives and Chinese officials during that trip. But, of course, it is an overhang here. And I think in some ways is sort of the uncertainty and the slightly muted response that we've seen from Beijing so far. They are biding their time to see precisely who it is that they're going to be dealing with once we get past November. If we do, of course, get Trump, who's mentioned, as we know, those 60% tariffs. I think those 60% tariffs, probably that's just the start of the negotiating point. It's probably going to be lower than that. But it certainly suggests a more antagonistic, perhaps a more confrontational relationship between China and the US. And the backdrop here is that FDI in China has been really weak. It fell to 33 billion US dollars last year. That was a 30-year low, 80% down just on the year before. And the sort of general comment that I hear from foreign investors, these sort of business groups, is that essentially the companies that are already in China, they are committed, they are going to stay, they have to, it's a core part of their business. But for the companies that perhaps had smaller operations, that it's not so central to their business, that were maybe just sort of dipping their toe in, they are the cohort who really have pulled back, who are really still very hesitant and not quite convinced, in part because of those sort of contradictory signals, and they're waiting for clarity to see just how much this push on self-reliance, this push to innovate, might ultimately end up costing foreign companies and private investment in China.
All right, Asia government and economy correspondent Rebecca Chun-Wilkins there. Plenty more to come. This is Bloomberg. Here are some of the top corporate stories we're following. The Japanese developer of a job matchmaking app, Timee, jumped in its trading debut on the Tokyo Stock Exchange. It raised $306 million in the nation's largest IPO so far this year. That gives it a valuation of about $900 million. Timee is aimed at so-called spot work that matches employers with people seeking jobs for specified periods of time and locations. Bloomberg's learned that Meta is facing its first EU fine over claims it's abusing its dominance in classified advertising by tying Facebook Marketplace to its social network. Sources say the EU order will be issued in the coming months. Regulators may also tell Facebook to make a separate version of its classified ads platform. Russia is throttling access to YouTube, one of the last US social media platforms still available there. The Russian Parliamentary Committee says download speeds will be slowed by 70% by the end of next week. The committee accuses YouTube of an anti-Russian policy and deleting the channels of public figures. YouTube has blocked some channels that are pro-Kremlin or run by the Russian state. All right, let's take a look at some of the assets that are moving around the Asia-Pacific today, and the China 10-year very much in focus. That's hitting a fresh record low. There you see 2.18 at the moment. It did touch 2.17 briefly. This is data going way back to 2002. So those recent interest rate cuts from the PBOC not really doing the job in stemming the bond rally. We've got pessimism growing in China. Traders looking for havens, and those 10-year yields just keep on falling. Better story, though, for some of China's appliance makers. We've got home appliance and automaker stocks rallying. And this is after the announcement of measures to support trade-in and upgrade subsidy programs for consumers. Plenty more to come. This is Bloomberg.
We're expecting 2 rate cuts this year against that backdrop of slowing inflation. That should stabilise sentiment. So we'd see this as more of a positioning shakeout rather than the reversal of the long-term trend for today.
I think that would be warmly received at a time of year when historically it's better to be, taking on less risk than what's working. So to me, it's screaming Fed cuts are around the corner.
Okay, the US can cut aggressively like others if they want to, given the inflation pulse, but they don't have the pressure to cut as aggressively as others. The US equities are probably kind of well supported. The dollar is a safe haven as well as a high yielder. I'm not sure that story is really hugely changed.
Some of our guests there debating whether the Fed is moving up its plans for rate cuts. Welcome back. China markets just heading to lunch. We did have those US GDP figures hitting the sweet spot, so that's supporting some assets around industrials, and the selling really seems to have eased off in China. We've got the CSI 300 pretty much flat at the moment. We've got, as I mentioned, home appliance automakers doing pretty well. Also worth mentioning, though, that the China 10-year yield now hitting a fresh record low, and that's despite efforts from the PBOC to stem that bond rally, not really doing the job. Right, let's check in on markets in Japan. Avril.
Yeah, Paul, we're seeing Japanese equities also catching their breath a little. They're selling, they're easing as well, as we have that exhaustion, I think, catching a bit of a break, that selling that we saw earlier in the week. So stocks back from the lunch break, sitting slightly firmer. But of course, this is driven earlier in the week by the rally in the yen. We also had that AI narrative being questioned. The focus will squarely be on the BOJ next week, and the expectations are of QT as well as a rate hike. That's going to be a bad environment for JGBs. The yield continues climbing on the 10-year. The rally in the Japanese yen actually earlier yesterday took a bit of a breather after faster than expected US Q2 GDP numbers. We also got some data out of Japan earlier today, and this was Tokyo CPI, leading indicator of the nationwide trends, which shows that quickening for the core CPI, and this was driven by energy prices. This leaves the door open for a rate hike from the BOJ next week. Let's get the view from MLife strategist Mark Cranfield. Mark, let's unpack what we got on the data today. Tokyo CPI on the core front, it quickened, but it was slow on the headline as well as core. And we're also seeing signs that companies are struggling to pass on higher costs to consumers. Do you think in any way this emboldens the doves on the BOJ board?
It's unlikely, and we probably would have heard so already if that was the case. So it's a very interesting contrast. When we were going into the June Bank of Japan meeting, a couple of days leading into it, there already were leaks in the Japanese media, don't expect anything, even though traders had heard some fairly hawkish language from Bank of Japan speakers in the couple of weeks before. But as we got very close to the meeting, the Japanese media already damped down expectations. So by the time they actually met in June, the market was already thinking that not much is going to happen. That's why dollar yen went close to 162. This time around it's very different. The things we are seeing in the Japanese media support the fact that people seem to be on side for the Bank of Japan to do what in some people are describing as a double tightening, to do a rate hike, possibly up to 15 basis points, and to reduce the number of JGBs they buy as well. So quite a hawkish outcome, and that's obviously helped to drive dollar yen lower this week as well, and partly why the bounce that we've seen is not really that great so far. So between now and the middle of next week, as they meet, traders will probably continue to have a favourable outlook on the yen. And this time, unless they see something surprising, maybe the day before the Bank of Japan meeting, they're likely to maintain that bias all the way into the meeting itself.
So it sounds like all systems go for the BOJ. But what about the Fed in terms of the easing that we might see next week? And how vulnerable do you think the yen rally would be to that?
Well, probably the GDP data, as you were talking about there, probably extinguishes any chance of a July cut. So any hope for that is probably out the window. There wasn't much chance anyway. It's probably gone now anyway. But they will probably set up, the market is fully expecting September. The Federal Reserve will probably give plenty of guidance for traders to expect that to continue. Bond market is certainly anticipating it. The PCE data tonight is definitely important. The headlines are still likely to come in on the core, something like 2.6, which is still a bit higher than the Fed needs. But what they also will be looking at is that where incomes for people in the United States seem to be shrinking. People have used up the money during the pandemic period. A lot of people stored up money. Part of it was given away by the government. That money is pretty much gone now. So people's savings has been reduced dramatically, and it's starting to affect consumer confidence, but affecting how they spend in the US. The Fed will be aware of it, and that will be one of the things they will focus on. And probably for their outlook, that gives them the reason to be dovish and to set up rate cuts for later the year.
What's that going to mean for the front end of the curve then, Mark?
Continue to be well supported. That's what we've seen is the big driver. We're gradually, this inversion that we had in the curve, which was mostly driven by a very bullish outlook on the 10-year, starting to unwind. It's still now down to less than 20 basis points. Now it's being driven by the 2-year in particular. 1-year yield's also been coming down pretty fast as well. We'll probably see more of that as well. And if the Fed really does make it look as though 2 rate cuts are possible for this year, you might see us go completely back to flat on the yield curve. But certainly a lot more interest in the shorter maturities than the long maturities.
Are we going to see more of the unwinding of yen carry then? And what do you think are going to be the big winners and losers against that backdrop? We've seen how the yuan, the Chinese currency, seems to be holding up pretty well.
Well, the Bank of Japan still needs to deliver, of course, and they have had a habit of not meeting expectations this year, but let's say they do. Let's say they deliver on both fronts. That will probably force people to even take a bit more money out of some of these. There is definitely still some carry trades going on in the yen. They wouldn't have all been wiped out just in the last week, so some bit more of that to happen. Now, the People's Bank of China have been using this bit of weakness in the dollar very cleverly with their fixings. What we saw today was a bit of a surprise, actually. They set the dollar yuan fixing lower. They didn't really need to do that, actually. They could have just set it pretty close to where it has been all week. If they're fearful that the yen rebounds or that the Fed doesn't do what it's good. So the central bank in China, they seem to have an optimistic outlook that the Fed will deliver on rate cuts and that the Bank of Japan will do their job to keep the yen strong as well. And that's helping China breathe slightly easier, which is particularly helpful in a week when they've been lowering interest rates themselves. So it's playing nicely into their hands and they're taking full advantage of that.
Do you think they can breathe slightly easier given the Chinese bond rallies, or can it have its cake and eat it too?
Well, this is one where traders will be fully expecting now that voices from the PBOC will push back. And a Friday afternoon will be an ideal time for that to happen. There's been a very good rally again this week, which of course you would expect. They've lowered the reverse repo rate came down this week. You would expect bonds to rally. But they have clearly said before they don't like one-sided markets. And it's beginning to look a bit like exactly that again. People getting very bullish on the bonds. But they can easily come in and they can say, look, the curve's beginning too flat. We don't like it. We can issue more in the long end. We can skew our bond issuance towards the 10 and the 30-year sector. That weight will certainly make traders think again, not to be quite so aggressive in what they're doing. This is all the tactics that the PBOC can use. They will know the bigger picture is they need to help the economy. They need to get interest rates down, but they would probably prefer that the curve has a positive. They don't want to get into the inversion that America has. That's very disruptive. So they would like to retain something of a positive curve, and they've got many ways they can do it.
PBOC has a number of tools at its disposal to tamp down this Chinese bond rally. Mark, always insightful. Thank you so much for sharing your time and your insights with us. Mark Cranfield there, Bloomberg's MLive strategist. Back to you for now, Paul.
All right, thanks, Avril. Still to come, we're going to discuss growth strategies with KPIT Technologies. That's an Indian software services provider for the auto sector. Their CEO joins us for an exclusive interview next. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching the India Focus. Here's a look at how Indian markets are trading just ahead of the open, about 5 minutes away now. Looks like it's going to be a kind of a flat finish to the week, and we do have stocks more broadly in the Asia Pacific flat to going sideways at the moment. So the open there just under 5 minutes away. Well, the automobile industry is increasing focus towards technical enhancements and software development in vehicles, and that smells like an opportunity for players like KPIT Technologies, an independent software services provider. Now take a look at the stock price, up 500% over the past 3 years on the back of the company's strong deal pipeline, financial performance and strategic initiatives. And joining us now exclusively is co-founder, CEO and MD Kishore Patel. Kishore, thank you so much for your time today. So that stock price chart, very impressive indeed. The market certainly likes your story. So where are you looking at the moment for future growth engines?
So good morning, Paul. And I think what we have been focusing on is we are trying to, the automotive OEMs are basically, as the vehicles are moving towards more software on wheels story, we are trying to really figuring out being an independent player, play a role to work with the OEMs and basically realize value for them across the ecosystem and supply chain, whether it is tier one or semiconductor companies or other tech providers. That has been our basic focus. And right now, if at a high level, if you look at it, most of the conventional OEMs wanted to catch up with Tesla in the past 4 or 5 years, moving towards software-defined vehicle, centralized architecture. So our goal was how we can help them accelerate that journey and make it more dependable. And that has been our focus. Now, in addition to that, now we are trying to help them is basically how they can compete and reduce time and cost while competing with Chinese players.
Yeah, so you're talking about the OEMs there, that's original equipment manufacturers, but you do have competition between the European and Chinese manufacturers, and you do work with both of those manufacturers. Do you have different approaches and different strategies?
Absolutely, absolutely. I think if you look at Chinese OEM, I think some of them, there is again a lot of Chinese OEMs there. Some of them have really very impressive products, good technology, and there are also tech players who have a good advanced technology. However, I think the market, the Chinese market, is in some way getting stagnated. It's a flattish growth. So the only way for them is to go out and go to the external market, and they need help there in terms of looking at the compliances, integration, etc. That is one point. And the second is same is the issue with the technology companies in China. Also, the fact is they still need help in reduction costs further. Also, their next stage is having a better architecture of the vehicle in the software-defined vehicle. So these are the things which are on their mind. While we go to Europeans and Americans, if you look at it, but Europeans, if you go to, Europeans have to really catch up with certain areas, specifically in autonomous and experience, consumer experience, where Chinese have done a very good job. They would like to catch up as quickly as possible. Electrification, of course, they want to really make sure that they are as efficient and the costs come down drastically. And the most important part is how quickly they can bring the products to the market. In these areas, we help the European OEMs.
Mm-hmm. Well, you also have your own domestic market to consider as well. How do you apply those lessons and strategies learned from Europe and China back in the Indian domestic market?
India is still, I mean, it's it has a great potential, and the market, we are working with all the OEMs in passenger car, commercial, as well as off-highway vehicles. To really, again, they are all on their journey for upgrading their technology. So we are, of course, with our experience globally, we are helping them to get there. But other than that, we are also trying to see what are the, how we can really help them in terms of certain basic technologies. So for example, the trucks or commercial vehicle is a big market in India, and the battery costs are very high. So we actually worked on a sodium battery. We developed a sodium battery technology. And then naturally, we are not manufacturers. We are a technology company or a software company. We are not manufacturers. So then how can that then basically technology we are licensing to some of the manufacturers to develop, which will be great for Indian market, because that's something which is most of it is available domestically, and they don't have to depend on imports. So similarly, we are developing certain technology which are specific to India market, along with what learnings we can bring from outside.
All right. Just one last question before we let you go. You've got engineering, research and design seems to be providing somewhat of a moat for KPIT. How do you differentiate and succeed where others have maybe struggled?
So I think the key point is, if I go back a little bit and talk about it, 5 years back, we made a big change in our strategy to focus only on automotive because we believe that it is going through one of the most historic transformation in the automotive industry. And being focused, putting a lot of research and R&D expenses ahead of time, working with a clear strategy, not as a service provider, not as a this, but as a pure technology provider, as an integrator, both for software as well as system integrator, being independent than any hardware like a tier one, and then bringing innovation to the OEMs. That has really helped us. I think this, the clarity of that has helped us to really be ahead of the pack.
All right, Kishore Patel of KPIT Technologies, thank you so much for joining us today. And we will have more on the auto industry coming up as well. The Chinese EV battery maker CATL set to report earnings later, and we're going to break down why it's expected to buck the industry's weakness. Also, the Summer Olympics opening ceremony now just hours away. We're going to have a closer look at the preparations in Paris next. First, though, let's take a look at how Indian markets are tracking. We're taking a look at India bonds as well. We brought you the story of the China 10-year bond slipping earlier. Now we've got the 5-year yield slipping as well, 6.856%. We're approaching levels that we haven't seen since August 2022. Certainly been a lot of interest by foreign investors in Indian bonds, particularly those with longer terms. So yields for the 5-year slipping at the moment. On the markets, meanwhile, the Sensex modestly higher, 0.1%. The Nifty 100 better by 0.33%. More in a moment. This is Bloomberg.
We have different recipes. 500 recipe has been meant since 2 years for the athlete. We are there to help them to win a medal, you know.
The Olympics is a net positive, you know, the world has its eyes on the country, and business-wise, I think it can only be positive.
Everyone is coming to Paris for the Olympics, so of course it's a unique opportunity to meet. I think as CEOs and sponsors of the Olympics, we are used to discussing, but everyone wants to have fun.
Business leaders on the Paris Olympics ahead of the start of the Games. And with the opening ceremony now just hours away, France is getting ready for a festival of sport to provide some much-needed respite from recent political chaos. Bloomberg's Caroline Conan reports from the French capital.
The Paris 2024 Olympics kick off on Friday night for the first time in real life after the pandemic kept spectators away from the Tokyo Games the last time. It's also the first time in 1 century for the French capital. Christophe Macron has called Olympic Games after the last snap elections left the country without a parliament and no new prime minister in sight quite yet. As many as 15,000 athletes from more than 200 countries have already arrived in Paris, including from Iran, North Korea, Israel. They have in place the very high security. Russian athletes, however, will have to compete individually without representing their country. As many as 15 million visitors are expected in Paris during the Games, which could use the French GDP to as much as 10 billion euros. 10 billion euros, that's also the cost of the Games. France has pledged to limit public spending for this Olympics. And for the first time in history, the opening ceremony on Friday night will not take place in a stadium, but in the city along the Seine River. As many as 6,000 athletes will sail down along a 4-mile stretch of the river with a big finale at the base of the Eiffel Tower.
That's Bloomberg's Caroline Conan in Paris. And we're also watching earnings today. Chinese EV battery maker CATL expected to report second quarter results, with analysts expecting a jump in net income. So let's get some details now from our Asia transport reporter, Danny Lee. Danny, tell us about the expectations.
Yeah, CATL is expected to show a rise in net income, although a fall in revenue. But this really still bucks the trend of how other battery makers are faring at the moment. When you just look at South Korea's LG Energy, which is the third biggest player, it saw itself miss earnings estimates and sales shrink. So clearly, for some of the big other battery makers, they are struggling because someone like LG is exposed more to Europe and the US, where demand for EVs is not as strong, and they don't have a greater foothold in the world's biggest EV market, which is China, unlike CATL, which has almost a 50% market share. So there is a big contrast between how CATL, which is supremely dominant in its space, versus its peers, and how that's kind of benefiting its earnings.
Yeah, so how else is CATL bucking this trend?
So CATL really does benefit from having very low costs, and its ability to scale up upstream, particularly being more closer to miners and to the materials which help make the batteries and the battery cells. And so by having more exposure upstream, it has been able to ride on the gyrations of what we now see as a collapse in battery prices. And for CATL, which has been under pressure to cut its battery prices, it has been doing so in order to retain and still gain market share. And so by being able to be more upstream, it's been able to limit the impact of falling battery prices. So unlike its peers who are, would have to spend a lot more to catch up to CATL to be more exposed, CATL is in a much better pace.
All right, Asia transport reporter Danny Lee there in Hong Kong. All right, let's take a look at how markets are tracking. A few particular sectors that we're focusing on. It is, of course, the eve of the Olympics, so whatever motivates you, look at that. Stocks of apparel and sportswear gear, etc., seem to be rising at the moment. Fila Holdings up by 2.3%. Sports Gear Co. Limited doing very well, up by almost 8%. And that opening ceremony, as we mentioned, in Paris, due to kick off in just a few hours. Let's take a look at TSMC. Meanwhile, no surprises here. Having a bit of an off day, playing a bit of catch down. In fact, TSMC off by 5.6%. Taiwan, of course, reopening after being closed for a couple of days due to the impact of Typhoon Gamy. Hon Hai also weaker by 4.7%, although SMIC having a bit of a rebound in Hong Kong. All right, that is it for Bloomberg Markets Asia. We'll leave you with a look at our global market movers board. No surprise there, the TAIEX in Taiwan, one of the worst performing indexes today. All right, Horizons Middle East and Africa up next. This is Bloomberg.